Hey, hi guys, good morning. Sorry, I got a little late. I was struggling with my laptop. Cool. So we are about 1, 2, 3, 4, 5. Let's wait for another 5 minutes. Just check with the others. Yeah, see if they're walking in. And then we get going by 8:11ish.
Oh.
Yeah. All right, Swati. Hello. Hi, Sushant. Morning.
Hello.
Good morning, Rajiv.
Hi, Ria. How are you?
I'm good. What about you?
Yeah, all okay, all safe. How are things at your end now?
Yeah, till now, yes.
Okay. Still chaotic? All right, let's start. All in, let's start. Okay, great. So, what did we cover last class? Quick recap. What all did we take home last class? Quick recap, and then I think you were to write a small note on JM, right? JM Automotives. Yeah, I think 3 questions you have to answer. Sure. Who's going to recap last class and then we move to JM? That will lead us to DCF. Come on, guys. I know it's Sunday early morning, but it's equally early for me.
Hi, good morning. So the last class, we completed majority of the evaluation, understanding that in only in some scenarios, historic data is more important, specifically when we need to understand what uh, technology enhancement has been done in the near past that will impact the future sales and production. Uh, then we also saw that if there is a deviation of more than 5% between the standard and consolidation, then we should go in deep detail of what the difference is and which we should consider. Otherwise, we are okay to take the consolidated figures from the financials. Then, while we were calculating the equity share value to the equity shareholders, we have to consider uh, the diluted shares as well. So the diluted shares basically can be convertible notes, share warrants, ESOPs. ESOPs also, then we understood further that uh, how it works. So there are three things in it. There is a cliff, which is basically the time period uh, which the options cannot be exercised. They are typically 48 months, but it depends upon what the criticality of the talent is. Then there is a vesting schedule. That is the number of shares that you get uh, at a fixed interval, and that is how you can. That is how the shares allotment are done on the ESOPs. It also depends upon what role you are playing and how important, how critical that role is. I think the most important thing that we understood yesterday was talking evaluation, which is pre-money, ask, and the post-money. Uh, while doing any evaluation, we should actually understand what at which level we are talking, if the money has been infused or still is to be infused, and then accordingly you take out the investor shares. Investor shares is basically post the evaluation the percentage of holding that they want, so we need to calculate it accordingly. So I think these are the important points that we covered yesterday.
Good, Devanshi. Can you give an example of pre-money, post-money?
Like earlier, we had like in the example that we were doing. Um, One second. So in the example that we were doing, we saw that the implied asset value that came out was say 15,596, and then if we wanted a 15% a share after the valuation, we calculated basically the uh, how much should be invested so that it turns out to be 15% post the valuation. So the 85x calculation we did, and we got a figure of 18,348. In simple example, if we have 100 rupees right now, and if we want 10% holding in the company, what should be the investment so that we have 10% later? So 100 rupees will be the pre-money. The ask so ask will be, I say invested 10 rupees in it. So the post value will be 110. So what would be my share would be 10 or 110. So that is how it will be.
Okay. Any questions, any thoughts, any clarifications needed?
No, I was pretty clear with what we did yesterday. So
Anybody else? All good? Sounds good? Okay. Okay. Now let's get to JM. Yeah. Has anyone made a small note as requested last time?
I did, but I have done on my notebook since I was just reading from my mobile and writing. So I have made few notes about it.
So why did you convert that into a Word doc so we can go through it? Who else? Who else? Someone else?
I have made notes with respect to that.
Sorry, Akanksha, what is that?
I have made notes for it.
Okay. So can you share that, or is it on a notepad?
I can say with saying about JM automotives, right?
Are there 3 questions, right, which I left you with?
Yeah, I can share that fine.
Okay. Who else?
Hi Rajiv, I was not present in the last class, so can you please let me know what we have to do?
Okay. Who's going to help Priya?
Riya, so in the last class we had to study. So we have to do the DCF model today. So we were asked to study about JM automotives and make a small note on the drivers of JM, identify the peer set, and also what do we value the most in the company and why.
Okay. Thank you so much, Devansh. Got it.
Cool. So thank you. Okay. Ananta, did you?
Yes, I'll try. I'll share my screen.
Okay. One Sushant, Shiva, Sushmita. No? Cool. So we will start with folks who have done. Let's start. Who wants to go first? Kansha?
Rajiv, sorry to interrupt, Kansha, but JM Automotives is a private company, right? Just wanted to confirm.
Yes.
Okay. Thank you so much.
Okay. Okay. Akansha, we start with you or no?
Yes, I can start.
So I'm making you the presenter. Let's go. All right.
Is my screen visible? Yes, yes, yes. So for JM Motors, we had to figure out three questions majorly. What are the business drivers? What do we value in JEM? And the different peer sets for JEM. So JEM Automotives basically majorly works into the R&D sector. It also looks after manufacturing of automotive component systems and prototypes. It works towards the detailed designing and analysis along with the powertrain engine, vehicle engineering. These are the various kinds of activities performed at JEM Automotives, and it also looks after its infrastructure facilities and works with Tata Motors in providing various kinds of automotives. Recently, the JM Automotives special vehicles. This business has been taken over. Majorly 50% stake in it has been taken over by Tata Motors in order to grow further in the automotive sector. Then comes the value. What do you value the most in JEM and why? Valuation. If we'll perform valuation of JEM, it works majorly on the R&D sector, and that is its major source of income. It's performed various forms of R&D with respect to its various components and the automotive parts. The peers for JEM are Steven Electronics, Olins, Bignell, Sage Automotive Interiors, Elio Motors, and Windspeed. All these work into the similar lines as JEM Automotives. This is all I could gather.
Okay, Akansha, good. Now my question is, while you were doing the preliminary research, does that excite you about the business?
I was reading about it that JEM Automotives has been working with Tata Motors, and I went through this deal. So I was just reading a bit about it. I
So
came across the article and I just read about it.
No. So my question is, does it excite you to invest, not invest?
Frankly, currently I could not make any decisions because it was just sorry. Its major work is automotive R&D, so it did not attract me much.
Okay. All right. Cool. Sounds good. All right. Akanksha, thank you. Let's see. Ananta, we go to Ananta now.
Okay, Raj.
All right. I will do the question.
Can you see my screen, Raj?
Not yet. Yeah.
These are the business driver which I have seen in JM Automotive. These are more into research and development of the engineering products. And they have some manufacturing services, what they're given with fabrication, steel and ferrous, aluminium, and engineering services with the powertrain engineering, vehicle and engineer components. And I have found only 5 pairs of JM. Sion Electronics and Aurangabad Electricals, Tower International INC, Sage Automotives, and Helio Motors. That is what I've done yesterday, but I've not gone through any depth of JM Automotive. Can you hear me, Raj?
Yeah, I'm listening. I'm listening. Yeah,
Just
that's
I've
it.
done only the basic. Yes, I've done only basic analysis.
And what's your call? What's your take on this?
I can't take any call right now because I've not gone in depth of this automotive company.
Okay. Okay. Cool.
Thank you.
Devansh, are you ready?
I
Your note?
can. I have the notes in hand, but I cannot share the screen because I have them in writing.
Okay. Take care. Talk to us about it then. I mean, ideally, you were supposed to document it. I don't know. It would have taken, I don't know how much time.
Actually, my laptop had crashed. That is why the last class also at the end I wasn't able to join. So today also I've joined through my phone. So that is also one reason I could not document it.
Okay. Take care.
Nonetheless, so JM Automotives, what I read was it is into the R&D business. It has design, development, testing, and manufacturing as a wide range of components, and also systems and stereotypes. So they have an integrated they do integrated parts, lighter and durable into two-wheelers, PCR, construction and agri equipments, race cars and commercials and highway vehicles. Their main customers are Tata, Ford, JLR, Hyundai, Hero, etc. They are into individual automotive components, custom design frames, engine redesign, and into turbochargers. The pure set which I found of JM was a little different than what Akanksha and Ananta have shown. They were Cosmos, Engitech, Banco. So Cosmos Engitech is basically into contract manufacturing of precision machines. Banco is basically into manufacturing engine and seating systems and cooling systems, etc. Then there is one is AMA, which is accessory machine agricode, and they are into manufacturing and maintenance of agri machines, highway vehicles, and gardening machines. So I think this is the pure set which I found out to be. So now recently they had a JV with Tata for enhancement and uh, basically make a better performance car, but then the JV continued because they came up with two cars, which was Tiger and Tiago, and it did not perform to the benchmark that they had thought. So the JV got dissolved, and the JV is now a wholly owned subsidiary of Tata Motors. So I think this is a very risky business because there is a constant R&D which is going on to in various fields. So the decision making for me basically would be on what they have to offer, and most importantly would be the timelines. Looking at the GV getting failed also gives me second thoughts on whether to go with JM or not.
Okay. Sounds good. Others are welcome to share their thoughts. Okay. Now, my next question is, how will you put a value to JM? Any thoughts on that?
So basically, because JM was a private company, I tried searching a little on financials, but I got nothing. So the next best way to put would be evaluating the peer set that JM has in the similar field, and then probably going ahead with the evaluation.
How? You'll evaluate just it, but how?
How would be
What's the approach you'll take? Forget whether it's private, public, doesn't matter, right? What's the approach we'll take?
We could.
Others feel free, okay, to just chip into this question. It's not only for one person.
One second, I'm just.
How about the rest? Akansha, how will you value this? Ananta, what's your approach? Forget data private, not private. What's the approach you'll take?
Value this. I'll first go for the PSX, which I have shortlisted, and we'll find out the EBITDA and sales for them, and then accordingly we'll go for the comparison table.
Did you check, are those company private? Is the data available? And is the peer set? What will you take from the peer set?
Rajiv, what I will do is first I will select the business, like for example, the e-mobility section. I chose the e-mobility section of GEM Automotives, and then I will search for the similar kind of like companies, the automotive suppliers, which actually excel in e-mobility section of the automotive industry.
Okay, yeah. Okay. Ananta, your call. What's your call on this?
Yeah, they are more on R&D development. So I would like to take the pairs which have the R&D in engineering products.
But they have a transaction, right? What if there are no transactions? You just can't take a trading multiple, right? Just a peer set, and you get my point?
Yes, yes.
Yeah, so think about it for a while. Any thoughts? Or or should I say that okay? So let's walk us. Let me break this down. Okay. Now, JM is a tough nut. Okay, it's a very tough case, and there are very few precedent transactions in this space. Very few. So it does not really, suffices the precedent transaction multiples. Which one should we take? In fact, at this point in time when we were valuing this, I was valuing this, and we stitched the transaction. This was way back in 2011. It was one of the toughest M&A transactions that I ever did. Okay, purely because not there was no data available, extremely scarce data available. Okay, that was frustrating for a very long time, and when we look at India, there are very few. In fact, JM is still the only company to do what it is doing. There are very few others who are able to pull off what JM is doing. All right, and so the uniqueness is very high in that case. So we were hired by a very large automotive R&D company, an automotive component manufacturer, very large. I cannot name the name, but maybe I'll, as we progress, we can talk about it, right? They asked us to value it because we wanted to buy them out. The question was how? How do we do this, right? And this is where you need to be a little creative on how do we value a company like this. Okay, how do we value a company like this? And trust me, you will be thrown into similar situations more often than you can imagine. Not always the data is going to be available. Okay, not always you can figure out a peer set and imply, as we did for Aurobindo. Aurobindo is the easiest one that we did. Okay, so let me walk you through how to deal with a scenario. How to deal with a scenario where the businesses are very unique. So and also where precedent transaction multiples are not available. Okay, what do you do in that case? Legit scenario, right? Very realistic. Could happen. What do you do in that kind of a scenario? So the first thing that we do, and let me start sharing my screen now. All right, fair enough. Okay, the first thing that we do is understand the business drivers in detail. Okay, what drives value for JM? What drives value for JM? What are those different unique parts of the business that we need to value? The first thing, what you just did. Okay, that's why I left you with those 3 questions. Then we start moving straight down to level 3. And interestingly, for such situations, you will have access to level 3 straight away, access to management and the likes. Okay. So what did we do is, one second. I'll have to stop sharing. 1 second. let me walk you through the actual output. Okay, this is what we built. This is what we had presented. All right. All right. So we will walk you through the order book basis. So we go and value the order book. Okay, what does the order book of this company look like? And basis that we'll start valuation. Okay, and the presentation that you're seeing is a presentation that you will have to build to present valuation case studies. It's just not an Excel. Okay, so if you that's why I've been asking you to start writing notes, making notes, write a valuation note, which I think you have for Aurobindo, right? We've not yet gone through that. All right. So let me walk you through the real world output. So the first thing that we do for the order book basis is how we start valuing. Okay, we build a certainty index. So for each of the bases of the orders from where JM is going to get the orders, okay, what is the source of the order and what is the certainty of converting into sales? So order book is different from sales. Can someone tell me the difference between an order book and sales? What is the risk element there?
I think the order.
No, we can't hear you now.
The order book usually involves all the deals, whether the deals have reached to the final conclusions and have actually been went for, and even if we had proposed certain deals, we mention them in the order book. While sales is the actual deals happening.
Order books are like whatever in future you are going to deliver. You have committed to the organization that you will do it, but after you have booked the deal that you will fulfill the order in certain time period. That is what in sales what you have already sold off.
Correct. What's the risk in the order book? What is the business risk
in order book? It can be cancelled if it is not committed to the timelines and all.
Right. So the risk is in an order book. Okay, an order book, or it's also called the purchase order. Correct. It's also called the purchase order. The purchase order is like an open order for buying the products, okay, in certain quantities at a certain price point, okay, okay, with a specified payment schedule. Correct? That's an order book.
Yes, yes.
That's an order book, right? So I like an order book is very important for any B2B business, any B2B business, technology or B2B tech, B2B non-tech does not matter. Even if it's Walmart buying apparel from a manufacturer in Tirupur, it will have an order book. So this is the mainstay of sales. Okay, purchase orders is a very good indicator of sales. The risk is purchase orders or POs as they are called, okay, can be stalled. What that means is, if say the PO says we will buy 1,000 quantities of goods, the actual sales could only be 500 because of whatever reasons. So PO fulfillment is very, very important. Are we fulfilling? Are we not? We as a company, we are willing to fulfill. Okay, assuming everything is in line, everything is managed well, operations are managed well on our side. But on the client side, on the customer side, if the customer does not call for orders from the PO, if it does not call for orders from the PO, your sales will decline. So the most important thing you should look at in any B2B business to value is okay, are you getting into a purchase order business or not? What is the purchase order looking like? Is that making sense? Everyone okay with that? Now we know what a PO is, purchase order is? Yes. Now PO is one of the elements of the order book. It's like a sales pipeline. So effectively what we did here is, and I was leading this transaction, what I did here was, of course with the help of management, I'll tell you how we did it. What I did here was, I was trying to understand what the sales funnel is looking like for JM, and sales funnel, okay, broken down by source of potential sales. So the source of potential sale, one is purchase order, the probability is 100%, right? Largely it's confirmed. Very few times the purchase orders are not fulfilled. That's a rare scenario. Something drastically has happened, or some outlier event has happened, like the COVID scenario now, or maybe there are some massive quality issues, okay, something like that, or a major strike or whatever has happened. Otherwise, if we take out these outliers, the degree of certainty for potential sales from an order book is 100%. Okay. Then we have RFQs. Does anyone know what an RFQ is? Explain an RFQ.
It is a requisition for quotation.
Request for
Like
quotation.
you,
okay.
Right. So whenever you are selling something or like that, you have to give the specifications of like whatever you want, whatever products you want, along with the price quotations.
Okay.
Is that so? You can get these RFQ. Suppose you are an organization, so many and you want to buy something from outside, so you require the RFQ from the different organizations for the same product. So whichever fits into your specifications, you go for that.
Yeah. So good. Spot on, Swati. Right. That's what an RFQ is. So let's understand how an RFQ gets generated. Okay. Here in this case, the James business development team is out there on the field talking to potential customers. Okay. And say one of the customers say is BEML. Okay. And BEML calls, has a conversation, visits the JM plants, understands the quality metric, all of that, the manufacturing processes, all of it, right? And then JM says, and then BMS says, okay, great. Give us a quotation for X number of quantities for X product. Give us a quotation. The quotation will include payment terms, pricing, any discounts, all those kind of things. It's a very technical document. Okay, it's a techno-commercial document which has the technical specifications to start with, and then it ends with the commercial specifications. That's an RFQ. Now, RFQ for B2B, there's a high probability for to get converted into potential sales. For a company like JM, which is customized engineering and prototyping, okay, there are not many companies like calling for an RFQ. There's a very high potential that it will convert into a purchase order, and from a purchase order to a sales. Cool. Now the basis for assumption is potential customer conversation. So I was actually asking, okay, how many customer conversations are we how many potential customer conversations and conversions are we having right now? Who are these customers? Correct. Okay, why will they apply? So I was actually analyzing VML, Tata Motors, M&M, okay, these kind of clients. Harley Davidson, these kind of clients, will they really issue a PO, or are they just shopping around? Okay, so I'm taking a very internal, external, internal, external. I'm shifting between the two realms of what's happening. Okay, the next, RFQ, everyone's clear on RFQ? Yeah. All okay?
Yes, yes.
Yes.
The next basis for order book. What does an order book consist? You're looking, okay, any inquiries or letter of intent that you have, and what are the kind of customer interactions that you've been having? Okay, a phone call, a site visit, a quality inspection visit, okay, engineering conversations, engineering prototyping workshops. These are all customer interactions in an industry like this. Okay, so we said, okay, JM management and I felt we are not that confident about 80%. We don't know unless they ask us. Okay, after the initial inquiry, they ask us for an RFQ, then the conversion to a PO is easier. So we took it at a lesser degree of certainty. Okay, and I will break down each of these going forward. And then we look at last, okay, how many emails, how many random emails, how many cold calls, emails have you been having throughout it, right? Which is based on, you know, how the JM internal team has been fielding, okay? 65%, we don't know, okay? So the learning is, okay, real world out there, practical valuation happens on this list. When there are no peer sets, when the company is extremely unique, okay, and because it's unique and there are no direct peer sets, the possibility of a precedent transaction multiple is very rare, unlike Aurobindo, right, that we saw quite a few number of, and unlike the other auto company, right, that we saw for Spark Minda, right? So now we understand that it is very critical to understand the business model, the industry, and more importantly, how does business function? Sales kaise hota hai, batao. Very important to understand for you to be really, be up there in the game of valuation. It is way beyond just knowing accounting standards and P&L, how to read balance sheets. Sounds good? So far, so good? First step.
Yes.
Okay, and this will come with
Yes.
access to the customers, and in these kind of situations you will need to talk to customers. Okay, there is no other way. All right, super. The next step, what I did, okay, I broke it down by each line of business. Okay, by each line of business. Now I'm going to pause for a while, and I will let you spend some time on this slide. What do you extract? What do you infer? Okay, take the next 5 to 8 minutes or say 10 minutes, make notes. What do you infer out of this slide? Okay, we've just built up degrees of certainty for the order book. Now the next step I did was break it down into different business units, which are very unique, very different from each other. Okay, so after about 5-8 minutes, I would like to hear from you guys. What did you extract from this particular slide, this particular step? Okay, go for it. ping me when you're ready, okay? Don't wait for me to prompt you. Ping me when you're ready. Read through, connect this with the website, okay? And more realistically, that's all that you'll have to get started with. All right, Devanshi, let's wait for the others. Meanwhile, you can dig a little more. Swati's done, all right. Okay, let's start. What do you expect? People who read, analyzed, made notes.
So what I basically understood.
In this order book,
Go ahead. Go
okay,
ahead,
in this
Swati.
order book, we can see that you have divided it into 5 segments, of different drivers. I could see that in first, like engine endurance, you can see in 2012 you have the PO amount of 880 lakhs. Fine. That after that might be they have can in the next year. I think this is a regular contract renewal process. Okay, they are they are regularly getting the contracts from the companies amounting to rupees 880 lakhs. So it is a less risky for them because they have their certain customer fixed, like they who are giving regular orders to them. In case first year we can see it is 880 lakhs, then we can see might have they have cancelled few orders that raised to 792, and then by order by way of customer interaction has raised to 88, which is also a fixed term. So I think it is a contract renewal basis process. Then in case of vehicle endurance and testing also, they have this contract is being renewed year by year with the same amount of values. Okay, similar in case of manpower augmentation, but in the category of vehicle and component design, you can see there is a variance. The orders by way of PO is 240. You have to work, you have to give more work on it. But this is not much giving regular incomes, or contracts are being not renewed. So you have to generate more leads. A similar is this next category, like in the vehicle component and design, which I could find, if I am correct.
Okay, that's good. Fair enough.
What is PO?
What
PO is a purchase order.
PO is for you. We just discussed PO, no? PO is the purchase order.
Okay, thank you.
So I can tell you, like, suppose you want something, you are working in an organization, right? So it has various raw materials for manufacturing your components, whatever you are making. So what happens? There are different departments which are looking after the different construction processes. So every department has the right to generate first the indent, what you want. So that goes into the purchase department, and the purchase department works on it, right? Then they find a suitable customer for them, from where you can purchase that material. So in that case, you issue a purchase order so that you can procure things from the other vendor, if I am right.
Okay, sounds good. All right, Swati. How about the rest? Devanshi, you were trying to say something?
So what I understood from this order book was that mainly their orders from Tata Motors has been is on annuity basis, and that is what is being renewed yearly. What interesting part I found was that in the vehicle and component design, if they do an investment, they have a purchase order by Harley for 387 lakhs, which currently is rejected because of their capacity constraint. So this can be looked into from an investment point of view, on what would be the investment, on how much the capacity has to be increased, and is it worth investing so much against the orders which can be received from Harley. Uh, I also seen is that the internal BD team is more involved uh, in the last two business drivers, which are the proto components, which is specifically, which I understood was for the defense and defense components. So there, majorly your internal BD team, I guess the higher team is involved. Otherwise, it's more on the customer interactions that they have been getting the orders in the other areas.
Okay, cool. Someone else wants to contribute? No? Okay, let me break this up. Okay, good. So what we've done, that's the first step you'll do, right? What I've done is I've taken each business unit, namely engine endurance, it's one business. Vehicle endurance and testing is the other business. Manpower augmentation is technical manpower needed for prototyping in the auto space. It's very difficult to get that talent. So that is a third business. Vehicle and component design is a fourth business, and prototyping, components and development. Okay, which is like these business units are the what do you call it? The more upstream, even before a car is seen on the streets. These things happen to every car. Okay, there is a prototyping, the engine endurance, vehicle endurance testing, multiple things. So James specializes in these kind of businesses. Now, for each of these businesses, I've broken it down into how much of the total orders, like for engine endurance, how much of the total orders is by way of purchase orders, which means confirmed, good degree, 100% certainty that this will convert into actual sales. How many by way of customer interactions, and how many by way of internal BDP, like cold calling or just people who are shopping around. Okay, that gives me the breakup. That's what I've done. And if you look at this, the most certain pieces of the business is engine endurance, vehicle endurance, manpower augmentation, correct, and proto components, the most certain pieces, because a large chunk of these is driven by confirmed purchase orders. By whom? Okay, so if you look at if you read the right side callouts, the engine endurance is Tata Motors annuity based contracts which are renewed annually. Okay, and there are different test beds for engine to do engine endurance, and there's a further strong interest from Volkswagen and Nissan. Okay, Volkswagen, Nissan, Leland, they have a joint venture. Nissan, Leland has a joint venture. Okay, or actually the truck business, that's the Nissan, Leland, right? And these orders are not yet factored in, right? Then if you look at the vehicle endurance, again, Tata Motors has confirmed POs, very strong interest from Ford India for 5 new models that Ford would be launching way back in 2011, 2012. And we saw Ford launching many new models after that, right? So most of them came from JM, all right? The design, development, endurance testing was done at JM, namely the new Ford EcoSport, the new Ford Endeavour, and all those, right, actually came in from here. Then again, very strong interest from Volvo. Volvo has been doing entering the Indian markets gradually, okay? And then they have initial dialogues with Daimler, okay, for with RFQ has been submitted. Same is the case with manpower augmentation driven by Tata Motors PO. And you know, if you observe very carefully, all these POs are post Tata Motors acquisition of JLR. Right? Can you connect the dots now? What's happening in the auto space? 2009 is when the transaction happened, right? TML JLR. Post which is what we're seeing all of these, initiatives that Tata Motors took. Okay. Vehicle design again driven by VML, Bharat Earth Movers Limited, one of the largest suppliers, defense contractors in India. Okay. Then this was also the vehicle design and component design for Harley Davidson. So Harley Davidson entered India via JM when they started building engines specifically for the Indian road conditions. All right. So that's a very strong traction. And then the last part, which is prototyping. Okay, again, VML for defense components, as I said earlier, and Mannheimel for the rest of the order book. Okay, it's a German commercial vehicle brand, huge company. All right, that's how what we did was we broke down the order book. Now that gives us an inkling on sales, correct? Is everyone with me? So I'm cleansing this business.
Yes.
Yeah, very important. That's what you do. Okay. Even for a B2B business where there are certain precedent transaction multiples available at level 3 and level 4, this is what you will end up doing. Okay, going very deep into it. All right, perfect. I had the I had the opportunity, and I was very fortunate to visit all these plants multiple times. And not once, but multiple times. Okay, I've also stayed put in a plant for a few weeks. It's a different experience altogether, right? When you are seeing things built in front of you, you have a different perspective to that business altogether. All right. So none of this is sitting in a comfortable air-conditioned office somewhere in Urban Point or those ivory towers. All of this work is done in the factory. Okay, really sweaty conditions. Okay, all right, that's where real work happens. Then we broke it down further into other businesses which were not so explicit in when they mentioned about it, but we broke it down further into low volume component development. Again, we broke it down in the same space. This was driven by TML, BML, and Mannheimel, right? And this is where I don't know if you guys recall the Indica Vista, the new Indica Vista. Okay, although now it's discontinued. So Indica Vista was actually developed by JM here. Okay, so that's where the low volume components came in from, and the Tata Aria. Does anyone recall the Tata Aria?
Yes, it's an MUV.
Yeah, it's an MPV. Tata Aria was launched to compete with the Innova, right? And the Chevrolet Tavera.
Yes.
Yeah, but unfortunately that segment died out. It's still Tata. It's still the Innova that rules the segment, and Innova launched the new Innova called the Crista. Toyota launched the new Innova, which is called the Crista now. But nonetheless, that was Aria, Nano, Vista was all developed here. And then we talking about D6 engines, very specialized high performance engines for TML. Now, this is where we are talking about the engines that we currently see on roads in 2021 on the Harrier, on the Nexon. Okay, those engines way back in 2012, 2013, 2014 were being designed, developed at JM. Okay, so I've actually seen this being designed and developed way years earlier. Okay, so that's the peculiar nature of the automotive and aerospace industry, which is something that you see today on the roads being used, or like an end product, was actually in development 10 years ago, or 8 years ago the work actually began. So that's the typical life cycle, product life cycle of these kind of industries. Very similar to a drug manufacturing. Okay, so performance vehicles. Let me split the question back to you. Does anyone know what performance vehicles mean? With examples?
Yeah, yes, it is. It is sports cars with high engine CCs.
Okay, can you name a few, Kostuk? Examples of
Yes,
performance? Yeah.
yes, Ferrari, Porsche, Maserati.
Okay, okay, and
We have the Jaguar F Type also,
and
and Koenigsegg, Bugatti. These are hypercars basically.
yeah, these are like hypercars. Absolutely. So, Kostuk, you're right, spot on. These are performance vehicles. To bring everyone on the same page, performance vehicles is a car, okay, that is very high on power, very high on transmission, but not fuel efficient. So people buy performance vehicles as people who know, as someone who wants to get an adventurous kick of driving that car. Okay. Now, Kostuk mentioned of the really top of the line performance vehicles, but let me give you examples of performance vehicles that probably we can afford in our lifetimes. Okay. Of course, we would love to afford a Maserati. Okay. But commonly available at the nearest dealership. Line of Grand Pulsar. Wow, what a car! Fantastic. And the best part, it's not as large, so it is pretty convenient in a city like Bombay to drive around and still park. But it comes at a steep price. Massively steep price. Okay.
Rajiv, there was also Volkswagen Polo GTI with
Yeah,
200 horsepower.
yeah, they are relaunching the GTI again, the Polo GTI.
Yeah, yeah.
That's the smallest performance vehicle. Yes.
Yes.
Yeah, but I'm not a big fan of the Volkswagen line, except the Jetta. Jetta was a fantastic car. I don't know why they discontinued. But given a choice between Volkswagen and Fiat, I would go with the Fiat. It's that raw power you get in Fiat, right? Oh. And the styling.
No, I didn't drive a Fiat actually, but I drove the GTI.
Okay, all right, yeah. Okay, guys. So, do we get an understanding of what performance vehicles is? Okay, and do you get the kind of depth you need to be in your target industry? It can't be very superficial surface, like CNBC analysts. Okay, sorry, but that's how they are. Very superficial. They don't go into the depth of nitty-gritties like these. Okay, so any industry that you pick, banking, fake, tech, whatever industry, go for it, but get this depth. Okay, you should be talking with passion. Okay, so performance vehicles, again, they had a lot of order from TML. At that point in time, TML was getting into performance vehicles with a joint venture with JM. It was called JT. Okay, but they discontinued it. Nonetheless, and then offshore design center, where they started, providing all these services, design services to the global clients. Okay. Again, interesting. They had requests from TML for 330 engineers. Incredible. So if you add up all of this, low volume, the order book, low volume components, performance vehicles, and offshore design, okay, forms the bulk of the order book, right? And that is what will determine the valuation going forward. Okay. Okay. Is everyone on the same page? Everyone with me? Is this helping? Yes,
Yes.
no?
Yes.
So
Yes.
if you were to pick a pharma company, you would do the same thing in level 3 and level 4. For each therapeutic area, what is the contract an Indian pharma company has with the foreign customers, right? Because if it's a contract manufacturer like Aurobindo,
Yes.
right? Yeah, after that $19 billion valuation that you did as level 2, level 3 will be actually this. Okay, sounds good. All right. Then the fourth part is once I have done this, I go to the assumptions and for the P&L. So I am actually building the P&L from scratch, right from the scratch. Basis the certainty of the order book for each line of business for each of the years, right? And I consolidate that completely, and I add a call out again where the assumptions exclude the motorsport business, okay, construction and farm equipment business. So let me give you some more context. Let me ask you, did you spot it? Okay, who's the face of JM? Did you find that out? Anyone? You had like a whole night to do that.
Something like.
Huh? What is it? What is it? No? BJ Chandran? Yes. And BJ Chandran and J Anand, right?
Yeah, a former F3 champion.
Exactly. Former F3 champion. And he's the first cousin of Narayan Karthikeyan. You know who Narayan Karthikeyan is, right?
Yeah, he used to
Yes,
drive for
yes.
Force India.
Exactly. India's first F1 export, right? Okay. So J Anand, so it's named after J Anand. JM is J Anand, right? So the thing is, there's a massive motorsport business that JM has. So they assemble F3 cars, F5 cars, F4 cars, and F2 cars, okay, and export it. And just to give you some more context, JM is located which city? Which city? Alright, come on, guys. Hygiene information you should have gathered by looking at any company.
In Coimbatore.
Coimbatore, correct. So Coimbatore, and in people, just to make you aware, Coimbatore is a very industrialized town. Okay, it's called the pumps capital of Asia, and that's where JM is located. Very high quality engineering talent. More importantly, JM, Coimbatore also is home to a massive racetrack called the Cariappa racetrack. Okay, the Cariappa racetrack. Now,
Voice is not. Your voice is
sorry.
not in between. It is not proper. Voice is not audible from your side in between.
Is it true for everybody or just for Swati?
I think it is clear. I didn't feel any problem.
Now it is clear.
Yeah.
Like,
Okay. So JM is also, Coimbatore is also home to Karyappa racetrack, which is owned by JM. Okay, actually owned by JM, and it's about like a 5 kilometer racetrack where they test all of the motorsport cars. So that's the interesting part, and they also do farm equipment where they do low HP tractors. Low HP tractors is anything less than 35 horsepower is a small low HP tractor. Okay, that's excluded, and COGS is considered as the average of the previous years. SG&A is considered the average of the previous years. Okay, and risk sales is considered only on the basis of confirmed purchase orders, RFQs, inquiries from potential customers. So that degree of certainty is here, and capex is taken 10% of sales. Okay, now JM is valued on sales driven by POs, RFQs, and advance. That's it. As is basis reflecting the valuation without business synergy. So we're not computing that. And we've done a DCF for a 6-year terminal cash flow. Okay. So, I asked you to make write a note on Aurobindo Pharma. This is what I was expecting. This is how you write a note, a professional note on valuation. Yeah. So you should go back, revisit the note on valuation for Aurobindo and make it explicit like this on the slides. All right. Then assumptions for working capital. Okay. Again, the customer credit policy. We studied the customer credit policy, the supplier credit policy, and not much of deviation expected there because generally it's been the policies, the credit policies, have been adhered to. So with that as a story, okay, and we will go to the Excel sheet. Hold on, but the context is important. Okay. Then what we did is the actual computation of cost of capital. Okay, we broke down the cost of capital, and there's a way we reached the cost of capital and the enterprise value multiples. Okay, cool. So what I want you to do, okay, I'm asking you, should we take a short break and then resume with the Excel working of this?
yes.
Yeah, but helpful. Are you guys getting the drift of where we are going with this? How to deal with such scenarios? Yeah.
Yes, yes.
And are you picking up the other pieces like how to write, how to communicate, how to make notes, how to explain your valuation methodology? Right. So all of this is the same thing, right? Explaining the valuation methodology. Right. Okay. Okay. So it's about 10:40. Yeah. About 10:50. Let's resume at 10:50.
Yeah.
All right. Cool.
Oh.
All right, I'm back. Cool. Is everyone back?
Yes.
Yes.
Good to go. Okay, cool. So let's continue after we've understood this. Okay, let me first, now we keep switching between the Excel model and this or that, the valuation approach. This is what I meant by approach when I asked you. Remember earlier in the day, what will your approach be like? That's very important. Okay, so this is the Excel model that I built for. Now this looks very differently from e-commerce model, right? Right, because it's a manufacturing model, looks a little different, but the principle stay the same. Okay, like assumptions. Okay, as you can see here, assumptions for income statement, sales, COGS, SG&A, depreciation, amortization. Okay, and your cash flow statement assumptions, and your assumptions for current assets. Okay, current liabilities. So this is a typical manufacturing, engineering, automotive model. Sounds good? So far so good. And then we this is a DCF tab, okay, for GM. Sales, historic period, okay, that we computed, which is already available, right? There's been a degrowth here. This is because of the global financial crisis that happened in 2008, but it had after effects right until 2020, 2010, okay? But then 2011 onwards, this is the projections that we did. So what we just did is the forecasting of sales. Forecasting of sales basis the order book. That is one very effective way to approximate the forecasts. Okay. And as we said, we've taken the COGS to be the average of the previous years, in the assumption note, the evaluation methodology. Okay. And so we have also taken the SG&A to be the average of the previous years, so on and so forth. EBITDA, depreciation, we arrive at EBIT, and you arrive at EBIT, which is earnings before interest, okay, amortization and taxes. So it's EBIT minus taxes before the taxes. Okay. Sorry, this is earnings before interest and after taxes. Okay, after taxes, what do we get? Then we add back the depreciation here. Okay, and we arrive at we subtract the capex. Capex will get it from the assumptions here. All right, we subtract the capex. All right, then we add or subtract the net working capital, which we will get it from the net working capital here. So we will start computing the net working capital. Let me zoom in. Okay, this is the net working capital here. So the sales, current assets based on the days of sales outstanding. These are your assumptions. Okay. Okay, and there is an assumption for net working capital, as we saw here in this part. The working capital assumption stays the same. There is very little deviations expected. Okay, this is all level 3 valuation. Okay, basis that we arrive at the unlevered cash flow. Okay, so you take the EBIT and you add back all the cash that is stays, that the cash, non-cash expenses, and adjust for the net working capital as well, and you arrive at the unlevered free cash flow for each of the years. So far so good? Yes, no, for us to proceed ahead. So far so good? Yes, no? Any questions thus far?
What is unlevered free cash flow?
I'm coming to that. But before that, all okay?
Yeah.
Yes.
Okay. Now let's understand cash flows. Okay. This is free cash flows. This is the cash flow that the business is expected to generate in 2012. Free cash available to do anything. Okay. Now there are different kinds and different levels of free cash flow. Okay. One is unlevered. So let's break this down, and I'll go to our valuation notes here. Okay. So free cash flows. Unlevered. Okay. What does unlevered mean? As English, what does unlevered mean as in English?
Without leverage.
Without leverage. Okay. And what that means is,
No loans and borrowings.
what that means is basically your free cash, okay, before the debt, before the effect of or impact of debt, correct? Means leverage. That is leverage, right? So unlevered free cash flows is free cash available to the firm, because the firm includes equity owners and the debt holders both. Correct? On the other side, levered free cash flows is free cash after the impact of debt, means leverage. After you have factored in leverage, the impact of leverage, which means debt knocked out. Okay, after you knock out debt or repay the debt for that time period, okay, whatever's left after that is your levered free cash flow, which means levered free cash flows is free cash available to the equity holders, right? So unlevered free cash flow is also called FCFF, free cash flow to the firm. This is FCFE, free cash flow to equity holders. After which you can use this free cash, the equity holders, which is the owners, can decide to do whatever they want to do, whatever the board decides. Either declare dividends or plow back, reinvest in the company, make some more capex, or maybe acquire another company. Whatever it chooses to do, basis what will generate the highest rate of returns. Okay. So far so good. Is everyone clear with this? The difference between unlevered and levered cash?
Yes.
We are now okay.
Yes.
Okay. So if you look at this model, we're talking of unlevered free cash flow, which means it's cash flow before the firm, before the debt impact. Okay. So far so good. Okay. We know how to get this part of the model. We are clear on this part of the model. Should we move ahead?
Yes.
Okay. Now what comes next is we have to discount it, which is we need a discounting rate. So now that brings us to WACC. Okay. What is WACC? How do I arrive at this 15.2% using the WACC calculator? Okay, but even before we go to VAT, okay, let's revisit. What is VAT? I think we covered it somewhere, right? We covered it somewhere here, right? What is VAT? Quick recap.
So it's basically the weighted average cost of capital, which considers your cost of equity and the cost of debt, along with what is the uh, market risk premium which is going on.
Okay.
So the cost of debt is simple to figure out because it's the loan percentage. Cost of equity generally is what the shareholders expect to get from the firm in return. And the beta is how sensitive is your company to the movement in the market. So that is how those are the three elements of weighted average cost of capital.
Okay. So what this means in simple terms is, what this means is, what is the rate of return, minimum rate of return the investor is expecting from the investment, right?
Yes.
Because it measures the risk. Risk, different components to the risk. There's a risk in debt. What if the debt defaults? There's a risk in equity. What if the company tanks under leverage or gets the product wrong, or is not able to get the right pricing for the products, or overspends on marketing? There's a cost, so it might just tank, right? And then there's a massive element in terms of the country risk, beta sensitivity, which is nothing but competition, okay, so on and so forth. Correct?
Yes.
So there essentially is the risk
Yes.
factor. So we want to discount this using the risk factor. What does discounting using the risk factor mean? Did we look at that? What does discounting actually mean?
You basically include the risk factor and then see how much would be the return if this risk is accommodated in that.
Yeah. So discount actually means, in other simple terms, discount actually means, or discounting actually means, what is the investor willing to pay, okay, to earn a certain return, okay, over a specific time period. Correct? What am I willing to pay now to earn a certain return over the next 1 year, 2 years, 3 years, 4 years, 10 years, whatever the time period is specified? That's discounting, right? Is that
Yes.
making sense? Simple as that. That's how you calculate FD rates. What are you willing to pay now to earn a certain rate of return at the end of 1 year? If it's a 1 year FD, correct? Simple as that. Same for a business. What will you pay now to earn a certain rate of return over the next 5 years, 3 years, 4 years, 10 years? That's discounting, right? That's risk, right? So essentially, the investor is shaving off the risk, correct, from the returns or expected returns, right? Sounds good?
Yes.
Yes.
In very practical street language, this is what discounting is. Let's not get caught up with the financial mumbo jumbo, because that will ever be in mumbo jumbo. They will never get to real world. So there's a massive disconnect between the way economics, financial textbooks are authored versus the way it actually happens on the street. Okay, this is what it means in the real practical method? All agree with this?
Yes.
Okay. So once we know this is discounting and this is the rate, it is measured in percentages. Okay. It is measured in percentages. So we need to compute the percentage of risk in that particular asset. And that is what is back here, which means the investor here is at bare minimum, the investor is expecting a 15% return to make an investment in this particular business. That's what this 15% means. Now the next question is, how do you compute mathematically? How do you compute, or mathematically, how do you express the risk or the investor's willingness to pay? Okay, to earn what? We will see to earn what. But let's first compute the back. Okay, but first let me walk you through the computation of back. What is the story? What is the approach? Okay, so here's the thing. I'm going to, again, just like last time, give you about 5 to 10 minutes, absorb this and give me the inference. What do you infer? Read through it. And then we'll go to the Excel again. Okay, 3 of you are done. How about the rest? Who's in? Rohit, Sushant. Okay, cool. So who was done? You want to speak in? What do you gather? And then I'll take you to the computation.
So I think the first thing that I understood was in what ratio is the debt and equity divided, as in what percentage of debt and what percentage of equity would be there in the capital structure.
Why? First, hold on. Why is that needed?
Because we know how much is the so if I have 100 rupees, I should know how much is my own money and how much I have borrowed. So I will know what to return, what amount is to be returned.
Okay, what more could be the reason? Little more specific.
And the cost accordingly will also be dependent upon the percentage of debt which is there in the equity. So how much is my own money invested to how much I have borrowed. So that is, I think, the whole point of it.
Okay, sounds good. So basically, you need debt to total capitalization to understand what is the fixed
cost to the company
fixed
that will come.
Fixed financial obligation, irrespective whether the business performs or no, irrespective whether the PO converts to sales or no. This is a fixed obligation, right? So what is that risk in the business from a fixed obligation perspective? Because the fixed obligation is FCFF, correct? And not FCFE.
Right.
Get it?
Right.
That is the perspective. Okay, cool. Let's see. Go on.
So once you've understood what is the percentage of debt, then the next step is the cost of debt. Here, one thing is that they have taken the after-tax cost of debt into consideration and not the actual cost of debt. So that I wanted to understand the reason. So they've taken the cost of debt is 16%, which they've taken from the convertible security debentures, and they have taken out the tax from it, and the after tax cost of debt is 10.7%. So now when you see the cost of equity, risk-free rate is as they have mentioned, the government bonds, the return that anyone is getting on the government bonds, simple investment in the government bonds. Market risk-free premium is 6%, which is global equity analysis they have come up with, and the levered beta is 1.28. What I understand from levered beta is how much does your stock vary when the with any fluctuation in the market. So they have taken two components here, Tata Motors and M&M, and basis that they have come up with the levered beta of 1.28. So the cost of equity is 16.3%. Now the cost of debt and cost of equity, they have divided in the percentage of the debt to equity ratio. So 10%, 19%, and from the cost of equity, the 81% equity, and then they have come up with the weighted average cost of capital of 15.2%.
Okay. And okay, that's Devanshi's view. Who else wants to share their view? Yeah, Swati, what do you observe?
Almost it is similar. Like first of all, we will start analyzing how much capital we have raised through equity and how much capital we have raised through debt. That percentage is already given, like 19% and 18%. Then as a cost of debt, that is 16%, that we'll get a tax benefit of 33%, and we'll out of that final value will come up to 10.7%. That has been computed as a cost of debt. Then there is a cost of equity. We have whatever component like risk-free rate that has been added to 16.3%. In similar way, we have as per the debt to equity ratio, we have taken the same in the weighted average cost of capital, and it has computed out to be 15.2%. So this is the final discounting value we have taken.
Okay. Now,
Question.
okay, dear. Fair
Here's a line. It is written that capital structure assumed to be normalized by financial year 12 on account of higher sales and margin accretion and positive net worth. So here I'm assuming that the company earlier used to have more of equity and very little of debt. Now, due to higher sales and margin accretions and the growth in their net worth, they have started like taking funds from like Tata Motors Finance in the form of loans or debts. So the debt to total capitalization is 19% and equity to total capitalization 81%. So it is using more of equity right now. Still, it is more using more of equity, and the after cost tax cost of debt is 10.7% because interest expense is a tax deductible expense. So how much they are actually giving to their the debt holders, and the cost of equity they have computed to be 16.3%, and the WACC 15.2%, taking like 10.7% into the 19%, and cost of equity 16.3% into 81%. So that's it from my side.
Okay. The rest keep adding in. Now, let me break this down for you. Okay. We start with, as I said, asked Devanshi, why is the debt to total capitalization needed? Because it's a fixed obligation, and we need to know what the risk is in capital allocation. If a large chunk of capital allocation by the equity investors goes in fixed obligation, does the growth of sales support generating FCFP? Correct? Is it enough to create FCFP? That's why it's very important. And here it stands at how much? What's the debt to total capitalization? It's about 20%, 19%, which means a large chunk is financed by equity holders, which means, if the company is able to manage its order book, okay, and is able to translate that into sales, plus if it's able to optimize its cost structure, okay, equity investors will be accruing a good amount of FCFP. Correct? Everyone with me? Is that sounding logical? So far, so good?
Yes.
Okay.
Yes.
Now, we start quantifying it. 19% equals about 8 crores. Correct? FY12. This deal happened, we have to go back in time. This deal happened in 2013. Yeah, 2013, somewhere mid of 2013. So FY12 numbers. Right? Devanshi, 813 lakhs is 8 crores, right?
It's 81 million. 813 lakhs is 81 million.
Which is 8 crores, no? 8.13 crores.
Yes.
Right?
Yes.
Okay, cool. Just checking. All right. Then we come to capital structure. Okay. And that's exactly what I've mentioned. Then we come to cost of debt, the first point of risk. You have to first quantify that risk. That is coming. How did we arrive at this? Not by randomly looking at cost of debt elsewhere and plugging it in. It goes down to the balance sheet itself. There are about 16% optionally convertible secured debentures from Tata Motors Finance. So Tata Motors Finance has lent money to JM at a rate of 16%. Sounds good? So far, so good. We know how to get cost of debt now. So this is level 3, private companies, which means you have access to a lot of information like this. If it's listed companies, it's very easy. And if it's private companies, you don't have still access to level 3, level 2, you can assume. Okay. And I'll give you certain sources. When we come to M&A, I'll give you certain sources on how you extract certain information. Okay. So far, so good. Then the tax implication at 33% marginal rate. Why? My question to you is, why did we compute the tax percentage? What's the relevance? What's the relevance?
It's because of the tax benefit, as I think Swati had mentioned.
Okay, go for it. Explain. Let's revisit that conversation. Why is why are we covering tax?
I want to understand because I didn't, but as Swati had mentioned, there
Swati,
was.
can you revisit your conversation on tax? Why is suddenly tax popping up here after 16% cost of debt?
They have certain rules, like they have like all the whatever loan they are taking have the this tax exemption of 33.3%.
Correct. So it's
I'm
not
not
tax.
clear on that.
No, okay. Anyone else? Anyone else?
In cost of debt, we have the interest rate. So for interest, there happens to be tax levied. So
Yeah.
that is the reason from cost of debt we like reduce tax rates.
Correct. So guys, go back to the P&L. We have EBITDA. We have EBIT. Correct. After reducing DA, depreciation amortization. Correct. And then you compute the, what do you compute?
EBT.
Earnings
Before tax.
Tax.
Correct.
Tax.
Essentially, earnings before tax. Okay. If you have repaid the interest and after you compute the tax. Correct. What this means is interest. Okay. Effectively, debt has tax benefits. Right? You can choose to, you can take 33% tax benefits on that, because 33% is the highest applicable corporate tax slab in India. Right? That point in time we are talking 2012. Now is the logic clear? So our effective cost of debt is 10.7%, right? You knock out 33.3% from 16% and you get 10.7%. Are we clear now?
Yes.
Yes. Sure. Everybody?
Yes.
Yes, Raj.
Okay. So which means going forward now we have to compute the cost of equity. Start with risk-free rate. It was 8.6% back then for a 10-year the Indian government bonds. That's the specific risk, and because the buyer here is a foreign company, it's an Austro-Canadian company, partial Austrian, partial Canadian. Okay, listed on the Toronto Stock Exchange. So foreign money coming in. So they wanted to factor in, if you were to park money in India, what is the best returns? Bare minimum, if they do nothing, if they don't take any risk of investing in the business, any of the businesses, forget JM, they can park money, buy some Indian government bonds and earn 8.6%, right? Minimum returns, risk-free, because assuming the Indian government won't default on those bonds, right? That's why they call risk-free rate of return, right? But in practical sense, anyone can default. And we've seen companies default and countries default on their sovereign debt. Okay, fair enough. But they said they want to have more risk. So instead of just parking money at 8.6%, we want to start investing. So what is the equity risk premium? So what is the market risk premium for Indian equities, which is calculated at 6%? Okay, I'll tell you where this comes from. Hold on. Okay, when we go to the Excel. Hold on. Okay, and we look at the beta. We look at the computation of the beta on the Excel. Okay, so park that thought for a while. However, can someone make sense of the levered beta comment that I have made here?
It can be, as we had discussed in the class earlier, levered beta. Levered also includes the impact of debt. So levered beta can be of those companies which have a certain debt to equity ratio in a similar manner, and their movement maybe.
Okay, that's one thought. What do the rest in the room think about the comment that we see on levered beta?
Considering the equity and debt portions, we
Does that make sense? And I've only taken the 1 year beta. That's it. Which is observable. You can get this beta from the stock market index. You just have to observe it, right? You don't have to compute. Are you guys with me?
Yeah.
Everyone?
Yes, yes. Yeah.
So what do we learn from here? Computing is important, but what is more important is how to think what to compute, right? And it came, and that how to think what to compute actually got discovered when we are taking a very critical lens on the business, which is sales, the most important aspect of the business. The assumptions engine, right, begins with the sales. Yeah, are you guys with me? So valuation, now do you understand once again, it's not knowing how to do accounts and Excel. Valuation is understanding business and then finding out relevant numbers that matter. That's it. And reducing all the noise around it. Are you guys with me here?
Yes.
Everyone else? Ananta? All good?
Yes, yes.
Rashmi, Shiva, Sushmita, Sushmi? Yes? Okay. So with all that analytical findings, okay, we come to the cost of equity, which is 16.3. and the WACC gets 15.2. Now let's go to the Excel sheet. Okay, let's go to the Excel sheet and let's see how the WACC is here. Okay, this is the Excel sheet. All right, the computational sheet. This is where we started out with. Yeah, debt to capitalization ratio. All right. Now we started looking at cost of debt that is observable. We knocked it out. Okay. 1 minus 33% from the cost of debt. So effective cost of debt is your 10.7%. Risk rate is observable. Indian government bonds, dekh lo kitna hai. Okay. And this is nothing to be computed. It is observable numbers. You can observe it. Okay. You have access to data from the exchanges and the RBI. You have these data. Okay. Levered beta. Now market risk premium is 6%. How do we arrive at 6%? Okay. So the note. So here's the thing, right? IBOTSIN, if you look up IBOTSIN, okay, IBOTSIN SBBI submits or publishes, like yearly table on the market risk premium for each of the geographies. Okay, so you have two options. Either you compute market risk premium by yourself, which practically is a futile exercise, or you can take it from the yearbook. IBOTSIN is the most reliable yearbook. Other is a little more expensive is Bloomberg. Okay, take the market risk premium, but also very interestingly, Damodaran also publishes Excel tables, okay, which are fairly accurate as far as risk-free rate goes and market risk premium goes. Okay, so you can borrow it from there, and we can make a reference to either IBOTSIN, or you could make a reference to Bloomberg or Damodaran's table, whichever that works. Okay. Now the argument is, I'm not talking from an interview perspective. Some interviewers will be like they'll like to screw your happiness and ask you, even though they know that no one computes market risk premium. Well, okay, how do you compute market risk premium? Show me the calculation. This is how you observe it, but how do you calculate? Okay, so let me pause and let me ask you there. If you were to compute market risk premium by yourselves, how would you do it? Give some thought to it and let me know. How would you do it? Refer to the valuation notes. Okay, let me know. How would you do it? Let me know when you're ready with it. Okay, think through, refer to the notes. Okay, Swati, hold on. Let's hear from the rest. All done? Everyone done? Need help? Some more time? Okay, Swati, walk us through. How would you compute the logic? Okay, I want everyone to develop this habit of thinking and clarifying logic. Okay, that's more important than knowing what valuation is. Bata.
As per the notes, it is like you have mentioned that market risk premium is the equity risk premium. Fine.
Right.
So
Right.
when we are computing, when we are where is the same? Then when we are computing market risk premium, we have to take in consideration the equity, what returns we are getting in the equity terms. How the annual returns, what all annual returns we are getting on a share trading prices. Like then we will that is called the market risk premium. Then we'll subtract the risk free rate from them. Then we will get this market rate premium. Am I right?
Okay, Swati, let's hear from the rest. What do you think of Swati's approach? No one? Guys, are we there? Is it helping? Is this or not helping? What's yes, no?
Yes, I second Swati's approach.
Sure.
Yeah, as per the notes, yes.
But is it now sounding logical to you? I know we did it a while ago, but is it sounding logical to you? Like if we go back here, where is it? The market risk premium?
Down.
Upar.
Yeah.
E portion.
Huh? Okay. It's the equity risk minus the risk-free return, right? So how will you compute equity risk? Sure. How will you compute equity risk? Swati? Ria? How will you compute equity risk?
From the stock market, because matlab, how much the right now market is offering to the equity holders.
Okay. So what will you specifically look from the stock markets?
We'll refer beta, how the sensitivity is to the market.
नहीं बीटा तो आ गया ना यहाँ पे. We are calculating equity risk, right? This equity risk minus the risk rate is market risk premium, right? So my question is risk returns, so we can observe from the RBI bonds that they have issued, correct? Then what else do we need is equity risk. ये कैसे लोगे आप?
We have the market share annual, and we can calculate how much annual return we are getting or on that. So we can calculate from that.
Okay, ठीक है. Let's get this straight. Okay, let's understand. How will you do this? If the interviewer asks you, how will you compute? Okay, here's the thing. So equity risk premium, right? So you will observe, okay, the index, okay, the barometer index, right? That is what is the most that will be reflecting the general behavior of the stock market. Yes, so observe the index, okay, and compute the returns, okay, on returns delivered by the index, okay, for the last 1 year, 2 year, and 3 year. Take the average. Right. So what this means is, if you invest, and if say this returns, the stock market returns, this is a stock market returns, okay, represented by the index, worst case represented by the index. If this returns is say about 20%, what this means is on an average, okay, the stock market in India will return 20%. So if the returns is 20%, what that means is, you're discounting your 100 rupees by 20%. Yes, no? All with me here?
Yeah.
Yes.
So far so good. Okay. So that which means on the other way to talk about it is the minimum returns a stock market investor needs to invest in the stock market is 20%, right? If it is giving less than 20%, someday you say the stock market नहीं डालेंगे एक साल, we will invest in gold, or we will invest in FD, or we will just let it lay in cash, or we will probably buy some cheap real estate, right? These conversations happen. Agreed? Yes, no?
Yes.
That's a minimum. That's a risk, right? That's what we saw. What is risk? What is discounting rate? Is the minimum returns. So now we go back to the Excel, and let's say the minimum stock market returns is 20%. Okay. What is the excess returns that stock market has given you? This market is equity markets given you over and above the risk-free rate is about 11%, right? Going by that computation. Yes, no? So far so good. Long-term
Yes.
average returns, right? Now this 11%, someone might say, no, it is only 6% because maybe they would have computed a much lower, stock market returns. They said, the excess returns, the stock market only delivers about 15% returns over maybe 3 years or 5 years, which is true. Have you computed that? Have you done that number? The CAGR? Have you ever
Yes.
calculated
Yeah.
Swati, yeah, you're cutting back and forth. You're cutting back and forth.
Am I audible?
Now you are, yes.
Hello.
Swati, yes. Now
I'm saying that since this company, I believe the company is not listed. So we will this market return we will consider for which peer company sets.
No, Swati. That's what I explained, right? This market risk premium that they are calculating is for the overall listed markets, right?
Okay, fine, got it.
Not the PSX. Why? Because you have to, think like an investor now. You have an option to invest in JM, or you have an option to park money in the Indian government bonds, risk-free rate of returns without doing anything, or you have the option to invest in an asset manager who will invest in the Indian equity markets, right? 3 options you have largely. What are you trying to compute? What are you trying to arrive by calculating the back is how much additional will this give me, right? JM will give me over and above the other 2 options, which is risk-free returns and the market, the general equity markets, right? That is the market risk premium you're willing to pay, you're willing to bear to take the risk for a certain reward that you will get when JM becomes big, correct?
Okay.
Are we clear with the logic? Everyone clear with the logic?
Yeah.
Sure? Yeah. How about the rest? Costo, all in? Sure? Rohit? Making sense?
Yes, yes.
Sure? You'll be able to do so. Shiva, Sushant, Swati, Sushmita, Mansha, Preeti, all okay? Okay? So it is a thought process that dominates. And if you go back to the notes, this is the precise reason why there is a lot of assumptions that go in DCF, and that is why DCF is the last resort. If there is no other way, then the only way is to do a DCF. Now you realize why? Does that strike you back?
lot of work
What is it, Swati?
is involved.
No, I can't hear you. Going back.
Calculation. Yeah, I'm saying lot of working is involved in this.
It is lot of work, lot of calculation. That is not a problem. The problem is too
Yeah.
many assumptions for too many calculations. So every analyst will have a different
Right.
assumption, right? A different reasoning, and that is where the price discovery happens, right? Right. So, are you feeling the challenge with the DCF method? But if there is no other resort, we will have to approximate, like we did here for JM. Even the cost of capital and even the cost of equity, the beta, we did not take any standard beta, right? We looked at the closest companies in the listed space that have the beta, and we took that beta, right? The sensitivity. Sounds good? Are we
Yes.
clear? How to compute the excess returns? So market risk premium is nothing but the excess returns the broader indices give you over and above the risk-free rate. Sounds good? Yes? All okay? All right. Now, should I give you a small activity? Small computation? Are you up for small activity, small computation? No? Too much to ask on a Sunday afternoon?
Yes.
It's too much to ask? Is that the yes or is yes
No,
or
no.
yeah?
We are ready for that.
Okay.
Okay. Okay. What I want you to do is find the 2-year and 3-year CAGR, 2-year and 3-year CAGR, okay, for Nifty. Effectively, I'm asking you to compute this number in E20 quickly. I want to see on the Excel sheet. Okay. So what you can take is take how much is the 2-year, 3-year CAGR for Nifty. You will get the data from where? Nifty closing prices. Where will you get the data from? Batao. Valuation is also business research. Where will you get the data from?
Control.
Money control is one.
Yeah.
LSE website is the other, right? The most reliable, whichever you're comfortable with, right? Cost book, yes. NSE website or money control, whichever is comfortable, okay? Or Yahoo Finance, whatever is comfortable for you, okay? So, how much time do you need for this? 15 minutes? Should be good?
Okay.
Okay, cool. Find out the equity returns for India. Sure. Okay, Akanksha's done that. Everyone else done it? Need 5 more minutes? Yes, no, 5 more minutes? Yep. Okay, awesome. 5 more minutes. Take it. Okay. Directly available from the site as in, Swati, what does that mean? Can you explain? Did you just pick the numbers from money control or did you actually compute it? I wanted you to compute it and not pick it up. Akansha, did you compute? Akaksha, Swati, did you guys compute Kaustubh, Sushmita, who's in Ria, Sushant, or did you pick it up? I wanted you to.
Right now.
I want you to compute. I want to see how I put it on Excel. So I want to see how you compute. Okay, that's the challenge there. Okay, and let ping me when you're ready with the computation of the Excel. Yeah, Akansha, have you computed it or it's skimming of the data? Okay, is the computation done? Do we have some numbers? Yes, guys, come on. Do we have the numbers so we can move ahead?
Hello.
Yes, I can hear you, Swati now. Thank you. Yes.
Yeah, I'm saying that numbers I couldn't get.
Numbers you couldn't get, why?
I'm trying it in medical control. I'm putting 2 years return, but the opening and closing price I'm not.
स्वाति हिस्टोरिकल में मिल जाएगा हिस्टोरिकल डेटा में.
Huh. Yeah, yes, tell me. Did you get or no?
Yes, I got the closing
I'll
prices
check.
of financial year 21, 20, 19 and 18, for which I have calculated the 3 years CAGR, and then I computed the 2 years and the 3 years average.
But where did you get the data from? भैया डेटा कहाँ से मिला?
Nifty 50 का Yahoo Finance historical
Okay,
data.
Okay, cool. So let me show you one source. Again, all of this is learning, guys, of how do you crunch numbers. Getting data is so important. There you go. If you go to nseindia.com, you can select whatever index you need, and we talking about Nifty 50 here. Select the time period, start date, end date, boom. You can export it. Yes. Okay. Okay.
Are you presenting on screen not visible?
Sorry. Is my screen visible?
It is visible.
Huh. So this is where you get the data from, right? Enter the start date, enter the end date, get data and export it. Okay. Okay. So Ria, have you computed? You got it from Yahoo, right? Yahoo, right?
Yeah.
Okay. Let's see your screen. Should we see your screen?
Just a minute. Let me show.
Your Excel. Should I make you the presenter? Walk us through the Kaggle computation. Who knows how to compute Kaggle on Excel? Does everyone know here?
Hello.
Yeah.
Yeah. So basically, what I did is I took
Wait,
the
let me make you the presenter, no? Why don't you show your Excel? Okay.
sure.
You're the presenter now. Go for it.
Am I able to present? Is my screen visible right now?
Not yet.
Not visible.
Is it visible now? I presented it.
And not
No.
showing in the screen.
Yeah, no, we can't see your screen. So let's do a smart thing, okay? All right. I'm going to share my screen, okay? And here, yeah, I'm going to give you remote control. Punch in the numbers here. So can everyone see my screen?
Yes.
Yes, I can see.
Okay. Chalo, yeah, punch your numbers here, no? That'll be better, smarter way to do it. And then let's see numbers. आपको numbers कहाँ से मिले? How do you compute? क्या करेंगे? चलो.
Sure. Am I able?
Yes, you have control. Go for it.
Not CAGR.
हाँ, बताओ. How did you
It
compute target?
will be the
Return.
it will be like value in March 21 divided by the March 20 value.
It will be
Then
F8
raised
by
to the power
F9
of
minus 1.
Okay, let me give control to many. So, one sec, help.
Rajiv, don't give it to me. I'm on a mobile.
Acha, I can't see you also on the name. Okay, Swati, I have given you. Also, I can't see your name here, perhaps because you're on mobile. So, yeah. Go for it, guys. Come on, come on. Compute CAGR. We're computing how much CAGR does Nifty give you? Has Nifty given you for the last 3 years and 2 years?
Yeah. This is not working on that.
But Swati, before that, we will actually compute the per year return also, no? Then we will compute the 2 years average and 3 years average.
My
You are not audible.
but you have mentioned here CAGR, so you will take it as a 1 year, 2 year. Okay. Am I audible now? Because this system is not working. I don't know.
No, you're really sounding very distorted. Like we can't hear you properly.
Do I have the control?
Yes, you have.
Now I audible?
Yes.
Ria, can you do it from your side? And my system is like, we'll help you out.
Okay, sure. So, shall I write it like
Okay.
per annum return?
You keep it CAGR. If it is for 1 year,
Per annum. That would be much. Now it will make sense. Hello, Swati.
it will be like F.
You are not
It would
audible.
be 70.8% for the first year.
Yeah.
It would be F8 by F9
Okay.
minus 1.
Minus 1.
Is it okay, Costa?
Yeah, looks close. Yeah. This one would be F9. Yeah. You drag it down.
Is it all right?
Yeah. Okay. So, what's happening here? What are the numbers? What do we think?
Yeah. So, first of all, I have taken the closing prices of Nifty as per 31st March 21 and 2019 and 18. And then I computed the CAGR or the return on equity per annum for financial year 2021, 1920 and 1819. Now we can compute the 2 year average by taking a financial year from financial year 19 to 21 and then 3-year average from financial year 18 to 21.
Okay. All right. Let me get it. So, any thoughts, Kaustubh, Swati, Akansha, others? Any thoughts here? Ananta,
Yeah,
Manju?
yeah. Look, it looks right as per me.
Okay. So what have we done is we've taken the closing prices. See, let's restate the problem statement. We need the 2-year CAGR. Okay, and we need the 3-year CAGR. Okay, which is compounded annual growth rate, growth over growth. That is compounded growth rate, right? All right. So what have we taken? 18 closing price, 18, 19, 20, 4 years. Okay. Now CAGR per annum, CAGR is always CAGR. There's nothing called CAGR. You just have to put whether it's a 3-year compounded growth rate, 2-year compounded growth rate, 5-year compounded growth rate. Okay. 1-year CAGR is not possible. The minimum, the least a CAGR is possible is 2 years. Okay. All right. So let's see what you've done. This is F8. So basically, 20 over 21 minus 1 into 100. Okay. This is for 1 year. This is not CAGR, right? This is simple growth rate.
Yeah, it's a growth rate. That's why I said let's call it market return per annum.
This is simple growth rate, no? Market return can be measured using simple growth rate, like you've done here. Market growth rate can be computed based on growth over growth, compounded growth rate, which is CAGR, right? So where is the CAGR here? And CAGR is more important than simple growth rate. Do you agree? Everyone gets the concept?
Yes.
CAGR versus simple growth rate. Okay, sure. So let find the CAGR. This is not the CAGR.
Yes. Yeah, that is compounded.
So compounded, batao. Also, you agree this is not the CAGR, right? What we have calculated. This is the simple growth rate.
Yeah, I at first thought that it is CAGR, but I stand corrected. Yeah.
Okay. Chalo, you want to take a stab? Riya, Swati, Kaustubh, Akansha, Ananta, you want to take a stab? Akansha, the math. Apply your math skills. You're good with math, right? You want to invite Devanshi back to the room. Ask her 10 raised to 9.
But I'm not able to understand how to calculate this.
Okay. ठीक है. चलो. Kaustubh, Swati, Riya, you want to stab it?
For 2 years, it will be like a how will you do? F8 equals to Can you help it, please?
Okay. You need my help or you're asking Riya's help?
Hello?
No, I can do it for you, sir.
Riya, she has a control?
Yeah.
She has the control.
Equals to?
Yeah.
Like F8, like fine.
F8.
That is the closing price of March 21.
Okay.
गड़बड़ होगा. Divided by?
Divided by?
Okay. Closing price of March 20.
As of March 20, fine.
Uh,
Into 100?
this full calculation F8 divided by F9, keep it in bracket, please.
Acha, okay, sorry.
Closed.
Into
ब्रैकेट नहीं लगाया हाँ रेस
Swati, you're not audible actually.
हेलो
Yeah, I'm sorry, I'm unable to
1 by
understand.
2 minus 1
Swati, can you please repeat?
raised to the power exponential raised to the power
Press shift 6. Yes, yes. That's it. The same. Open bracket 1 by 2. Yeah.
1 by 2.
Yeah, open the bracket 1 by 2 for the 2 years CAGR.
1 by
Close
2
the bracket minus 1. Close the bracket 1 by 2 after 2. That's it.
minus minus 1 close the bracket
Yeah, just
that
check
is
for
for 2 years CAGR into 100 that is 30%.
This is 1 year, na?
yeah, this is 1 year. Actually.
Yeah, come to 2019 ka 10. F10. You drag down F9 instead of F10.
Shall I write here F10?
F10, yes.
Okay. Done?
Done.
Now, 3 year calculation.
You just copy the formula and you just change the number.
Add one more year.
You just copy the previous one into the next cell and then edit.
Just copy it. No, just Control C and Control V. That's it.
Copy paste.
Yeah, copy paste and just give the reference for the 3rd year.
Just edit.
3.
That would be 8 now.
Huh?
8 हो जाएगा ना for 3 years.
12.
3.
Yes, F8. F8.
Yeah, F8. Yes.
F8 होगा.
Raised to the power 1 by 3.
And 1 by 3.
One by 3 minus.
Yeah, done. Check it once.
Yes. Put it into percentage.
I'm unable to control it anymore. Swati, can you please? Acha. Ananta?
Yeah, yeah.
Yeah, please, can you please take now?
Ananta, please help.
Yeah, I'm unable to
No.
control.
Yeah, even I don't have the control here.
Are you on PC?
Yes.
Rajiv, did you perform a coup? We don't have controls anymore.
No,
Yeah.
no. I've not taken the controls. Okay. Click again.
Rajiv, can you please give the controls to Ananta now?
Ananta, okay. There you go. She has the control now.
Sorry. Priya?
Yes, Ananta.
This is the one we have to do or not? We have completed.
Yes.
Okay.
I think
Cool.
we've completed.
Let's see. Let's see. So we went back to school, is it? Forgot Kagger. Yeah. We forgot Kagger. Not done. Not cool at all. Okay. Let's see. Kagger is okay. This is Ananta, right? This is F8 over F10. Okay. Over 1/2 minus 1. Okay, great. This is right. Let me check the other one. This is what? 2-year Kagger or 3-year Kagger? This one's 2-year Kagger.
First one is 2-year Kagger.
2-year. And this one's 3-year.
3-year.
Right? Okay. Cool. All right. Now let's understand this from a math perspective. I'm going to pull open this 2-year Kagger formula. Why did we do 1/2? What's the logic? And why did we do an exponential? What's the logic?
Is the square root.
Square root? No, this is not the square root. This isn't the square root. Why is it 1/2? What's the logic? Yeah, Ria? You
I
punched
also
in the.
want to understand because I just wrote, like, I just typed in what they told. I didn't understand it.
Okay, Swati, what's the logic? Any thoughts?
No, I think we have to revisit and gather information on that.
Go back to high school?
Yeah, from 10th class maths.
No, not from 10th class math.
8th class.
We are going back from a very jazzy concept.
5, 6.
Very jazzy concept called back to 6th grade.
But
Right?
Ananta, आया कैसे?
Huh. Ananda, you want to take a stab? Why? What's the logic of the 2? What's the logic
It's
of the 3?
compounding year by year.
So?
This is the number of years we have taken. That how
But
it
why
got
2?
computed.
Why 2? Why 2? Or why 3? Or why not 4? Why not 1?
No idea.
What's the reason? Fausto?
It's 1 by square root actually.
Square root तो ये है ही नहीं. And definitely this is not square root. Okay, let's break this down. Guys, logic, how we think is more important than any concepts on earth. Okay, problem solving. This is problem solving. Okay, let's take a step back. What are we doing? 2-year CAGR, right? Which means for 2 year to compute 2-year compounded growth rate, we need 3 years data, right? 3 time periods. Why? Why do we need 3 time periods for compounding 2-year CAGR? What do you think is the reason? What do you think is the reason?
19 से 20 में कितना growth हुआ, then 20 से 21 में कितना
Correct.
growth हुआ.
Correct. तब जाके 21st का number पता चलेगा, right? So effectively, this growth, this end number for 20 is basis what happened between this time period, right? One time interval of one time period, and this time period is 1 year, correct?
Yep.
Similarly, 1460.9, 14690.7, this end of period number is dependent on what happened between these time periods, right? Again, one more interval. Okay, so we need to know if you would have invested in this time period at this level and you would have exited at this time period at this level, what is the growth over growth? Now, these 3 time periods, there are 2 intervals of growth, correct? Do you agree? 2 intervals of growth. Are you able to visualize? This time period has how many intervals of growth now?
3.
Okay.
Yes.
And if there were one more here, then
Would have been 4.
4. So to compute a 2-year CAGR, we need to know growth over growth once and growth over growth once more. Correct? तब जाके 2 साल के बाद CAGR इतना मिला, right? This is so this 2 year that we see is the time interval for growth over growth. That's why we say it's compounding, correct? The 3 year is the time interval, which is 3 time periods, growth over growth over growth over growth for 3 years, right? That's why we need the four data points, the start and the end, which has to be the 4th data point from the start, because then we'll get 3 time periods, right? Are we good? Clear with the logic? Y2, Y3?
No.
No, the formula is not. I'm not getting it.
Sorry?
I could not get this at all.
So are you not getting 1/3 or are you not getting
The
3?
whole formula.
Forget the whole formula.
The same as that compound interest formula. This is
Yeah, so forget the whole formula.
similar way.
We are taking only one part of the formula and trying to understand that. Then we look at y1 by 3, and then we look at y raised to 1/3 or 1/2. So one component at a time. Is the 3 or the 2 clear?
Yes, that is clear.
Time period. Everyone's clear with the time intervals? Growth over growth. So take
Yes.
say
Yes.
year 1, year 2. 100 rupees डाला, यहाँ पे 120 रुपया आया. What is the growth?
20%.
20%.
20%.
And this 20% is for how many time intervals?
One.
1.
Now let's say year 3, and this comes to 150. Now
50%.
50%.
50% will be for year 1, year 2. That is simple, right?
Yeah.
But year 3 minus year 2 पे कितना मिला? 30 over 120,
25%.
right? 25%, correct?
30 over 120. Yes.
For one time period. But now for 2 time periods, simple में
50
कितना
over
होगा?
100.
It is 25.
Simple में क्या डाला? 100 रुपया डाला, 150 रुपया मिला. मतलब
Simple.
50 growth हुआ, but that is not the right number, correct? because at the end of year 1 you had the option to withdraw, correct? You did not. You reinvested your growth and it grew again. So what is the growth over growth, correct? So 2 time intervals, देखोगे आप? Growth over growth.
Yes.
So you want to see how much has 25% grown over 20%, right? Which is how much? 5 over 20 is 4, right? 4%, right? So ideally, your growth over growth should be end of period number over the principal value. We will see why we do raise 2, but 1 by 2 is clear now. Is the 1 by 2 clear? So you're 22%.
Yeah.
Now it makes sense. The 20% continues, right? But now growth on 20% is how much?
नहीं 1/2 फिर से
रिया कितने टाइम पीरियड से यहाँ कितनी बार ग्रो हो रहा है? कैपिटल कितनी बार ग्रो हो रहा है यहाँ पे?
2 times.
2 times. So you have to compute 2 times growth.
Yeah.
Growth, right? So 2 time intervals. This is start period, end of period, start period.
ये 1/2 की पावर
1 by 2. Forget 1 by 2. Just focus on the 2 now. 1 by 2 I'll explain later. वो 1 by 2 क्यों है and why not it is 2. ठीक है?
Okay.
The 2 का logic is clear. That is what we are focusing on right now. We are not
Yes.
focusing on 1 by 2. Everyone clear on the 2 का logic?
Yes.
ठीक है? Okay. I can realize it's 12:15 and we have we are shooting above that. Okay. But ठीक है. So far so good. इतना clarity आ गया?
Yes.
Okay. Now we'll have to shut the call, and next time we will continue. We'll finish this and we will finish this part. So we are very close to finishing back. Okay. Yes. No. Good. Helpful.
Yes.
Yes, sir.
Anna? Good
Yes.
session. Great.
Yes.
Okay.
Nice.
Next week we will try finishing this. We will understand the logic of this formula in detail. I mean, I would have continued, but I have another session starting at 12:30, and I need some break before that. Okay. So we will continue the 1 by 2 ka logic,
Okay.
and we'll also continue. There are certain cases where there is not 1 by 2, but there is 12 by something. Okay. We will look at those kind of variations in Excel. Okay. And that should help, and then we'll continue with everything after DCF. Okay.
Okay, Rajiv.
Okay, Raj.
Yeah.
Chalo. All right, guys. Take care. Stay safe. Right.
Okay, thank you so much.
Thank you.
Thank you.
Thank you.
Bye.
Thank you. Bye.
Thank you.
Thank you, Rajiv.
Bye.
Bye bye.